Hello, Excellence family. This is Christina Swangas, Agent Concierge. Today is Title Tuesday, and I'm able to catch up with Paul in between his meetings. Paul Sardone, our title attorney. Good morning, Paul. How are you today?
Hey, pretty good, Christina. How you doing?
Doing well. The hustle and bustle of the holidays is amongst us, and everyone is
Oh yeah,
running around getting ready. And with that said, we've had a few closings now, right in the middle of real estate tax season.
right.
So we wanted to catch up with you and talk about tax prorations and how that works.
Yeah, yeah. This is a topic that comes up at this time of year a lot because so the way the property tax proration works on a purchase, right, is depending on the time of the year that you close. So let's say I've gotten a few calls from buyers who close. Let's say you close in June of 2023. At the time of closing, we don't know what the 2023 tax bill is going to be because the tax bill comes out at the end of the year. You don't pay it in advance, you pay it for the year that just passed. So tax bill comes out in November. We close in June of 2023. Tax bill comes out in November of 2023. We don't know yet what the 2023 taxes are going to be. So the contract, most contracts, the as is, and a few of the other ones call for a proration based on what we know, which is 2022 taxes at that time. So you use the prior year's tax bill and give a proration. So basically what will happen in that case is the buyer will get a credit from the seller from January 1st, 2023 through June, let's say June 15, if that was the closing date, 2023, based on what was paid in 2022. What's happening now more than ever because of the way property taxes have kind of gone through the roof, uh, along with insurance and everything else. But
Mhm.
the tax bills are coming at the end of the year, and then now you got a proration, let's say, based on a $5,000 tax bill from 2022, and now in 2023 that tax bill jumped to $8,000. So buyers are saying, "Hey, that's not, I received too little credit at closing," but unfortunately, that's the way that it's handled. If it was the other way around, that did happen sometimes when properties were decreasing, during the last crash, when market values went down. A lot of times sellers gave buyers too much credit, but there's no equitable way really to do it. So we do have to base it on the last year, and there's no way we can have a crystal ball and know, hey, 2023 taxes are going to be this amount. So the good thing is when you do close in November, December, so the closings we're having now, we know what the tax bill. So we close a deal today.
Mhm.
The buyer's responsible for 23 taxes from today through December 31st, and the seller's going to be responsible. We know the exact amount. So closing in November and December, even closing in October, we can go based off of the trim notice, which is the anticipated taxes, which we do that. But it's something to keep in mind when you're closing early in the year. So let's say somebody who's closing in January of next year, they're going to receive a small credit from the seller based on those days of 2024 that the seller owned it, and then they're going to get hit with the tax bill at the end, which may jump substantially. So unfortunately, it's frustrating for everybody because I know personally a lot of calls that I'm getting now, people's escrow accounts are short. The banks also calculate your escrow bill. So when you're doing a loan and you have escrows, the bank is going to use the known taxes, which is the prior year. So in that, the person who closes in June, your bank is escrowing all year based on, let's say, a $5,000 tax bill from 2022.
Mhm.
When that tax bill is now $8,000, now they don't have sufficient funds in the escrow account. So they're readjusting your account. They're paying that difference. They're asking the buyer for the money. And now the buyer, is kind of frustrated, and I get it. I mean, it happens. It's happened to a lot of people. It's happened to all of us.
Yeah.
But it's something to keep in mind when you're buying is be prepared for that tax jump the following year. Based on and people that close this year too,
Mhm.
the taxes that you pay at the end of 2023 were based on the value that the county property appraiser gave the property on January 1st of 2023. So the
Mhm.
closing, people that close this year, maybe their tax bill this year, let's say you close in August, your tax bill came and it wasn't that bad. It's kind of like, but then next year, now your closing gets counted as a comp, so your taxes are going to jump. So there's always a little jump in the beginning. And then if you have homestead, then you steady out because it can't go up more than 3% per year. But it's just something to keep in mind, one of those kind of like surprise expenses that hits a lot of people. And I know in the closing, we always explain it and we kind of warn people, but it's a lot of information on that day.
Mhm.
So people tend to forget about it and then freak out when the tax bill comes. So it's an unfortunate part of this, but unfortunately, there's no way of getting around the taxes. And
Yeah.
I know in commercial deals, it's different. I structure it, my commercial deals, because there you're talking taxes that could be, we have one that the tax bill is over $100,000.
Oh my.
So everybody agrees that the taxes, either party can request a reproration of the taxes once the bill is available. But that's not how it's handled in the residential world, unfortunately.
Well, I think many times people don't realize there is a carrying cost to real estate. Taxes and insurance come with the package. And that's not to mention insurance can go up too. And there's
insurances have been skyrocketing, and that's another issue. So what's happening now is a lot of people who are already kind of tight with their monthly expenses with the mortgage and maybe qualified, but it was close. Now, when you add another $400 or $500 a month because of the escrow change with taxes and insurance, it's hard, and it's something where it becomes unaffordable. So unless something changes, that could be could make somebody have to sell, or hopefully not go into default. But it's something that unfortunately the mortgage stays the same. Taxes and insurance, there's nothing we could do about it. You can't ask you can dispute the tax assessment during that window with a trim notice, but most of the time it's not going to get you much relief.
Well, I think it's key just to know what you're getting into and plan accordingly. Have a small cushion in mind for if and when that increase comes. I've also seen where you've had, let's say, an owner of a home for 20, 30 years sell their property.
Yeah.
Now the new buyer is thinking they're going to get the tax roll from this buyer that bought in 1982, and now they're getting it at this year's rate. So there's a big there, right, for that buyer.
Right. So like, let's say a common scenario is, let's say you buy a house from somebody who's had it for 30 years and you might close in March of next year, and the tax bill for next year will still come at their basis because it's as of January 1st. So they're not counting your sales. So they think, okay, I'm good. My taxes are still $2,500, but then the following year, now it gets reassessed on your purchase. So the I've seen taxes jump, over 200-300%, because now it's not their basis anymore with the homestead. It's the new basis and based on the new market value, and the full amount being taxed minus the homestead exemption. So, I mean, it does benefit people if you have lived somewhere for a long time and you do the portability, you bring that with you. So the taxes, you might be buying a property where the current owner pays $8,000 a year in taxes, but you've had a house for 20 years and now you bring with you that carryover of the savings, and your taxes on the new property will be cheaper with the portability. So that does happen the other way, but for the most part, it's going to be where you're going to experience a jump. So when you're buying, and then with the way things have been and interest rates rising, the numbers are tight for people to qualify. So a lot of times these properties with low taxes are attractive because you can qualify. Oh, the taxes are only $3,500 here. I qualify, but then that's because the person that you're buying it from has owned it for however many years. So now you're in a situation where you can afford it for that year, but then your escrows are going to go crazy that second year of ownership because it's going to get reassessed based on the new market value.
Yeah, so I think a good rule of thumb is just to always remind the buyer of the carrying cost of real estate. It's not just a monthly payment. Be prepared for increases in taxes or insurance. As the owners, we're not in control of either. So we can shop insurance, but for taxes, it can come, and we just have to be prepared and just know so that we better understand the credits at closing and whatnot.
Yeah.
Really appreciate your help, Paul. And I
Okay.
want to remind all of our agents that Paul is here to help us. Any questions that come up with tax prorations or anything regarding title or anything like this regarding the closing, we are here to help and guide you and your client through the process. We appreciate your time, Paul.
All right. Anytime.
We want to wish you a wonderful week and just remind you that we are here. You can reach out at support@excellencetitle.com. You could call us directly at 305-595-7355, the option for title. We are standing by to assist. Have a great week, everybody. Bye, Paul. Thank you.
Thank you.